Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Ana Barillas, and I'm Aurora's Managing Director for Iberia and Latin America. Today, we have a very special guest joining us to talk about battery optimization, a very hot topic across a large part of the markets that we cover. I'm joined today by Jürgen Mayerhofer, CEO and co-founder of Enspired, a Vienna-based AI-driven trading as a service company focused on the optimization of batteries in power markets. Jürgen has spent more than 20 years at the crossroads of energy and technology. He wrote optimization algorithms long before AI was a buzzword, helped OMV modernize its trading desk, advised utilities with the advisory house, and then launched two trading software companies. The last one of those is Enspired, which now optimizes 5 gigawatts of flexible assets, including about 1 gigawatt of grid scale batteries across European markets. So, if I do my job right, during the next 30 minutes or so, we will dig into Jürgen's journey, demystify battery trading, and explore what it takes to unlock dependable revenues and finance for storage at scale. Jürgen, welcome to the podcast.
Thanks, Anna, for having me.
So, before we dive into battery optimization, Jürgen, you started out coding algorithms to move natural gas efficiently and then ended up spearheading AI-powered power trading. What drew you from pure software into the energy markets and particularly storage?
Actually, that's a very fun story. So I stumbled into the energy world because in Austria, when you work during school, this is counted like you would work in real life. And I got paid after the military service. And my military service ended in May. And I thought like I just stay home and get paid, right? And start working after summer. But my mom was not very supportive of that move, right? And it forced me to apply when I was like 19. And so I applied for jobs where I really thought like they will not be fun, including some specific software development jobs. And the first or the second actually job that I interviewed was about optimizing the natural gas grid. And I was so excited that I started during the summer already instead of doing nothing. And at the beginning, I did not know what I optimized, right? It sounded just very interesting from a technical perspective. And at some point in time, when I drove home, I understood what the yellow heads are next to the highway and what this big thing with OMV is, that this is a compressor station that I've seen in the database. And I realized that I'm really moving something physically with what I do, right? So importing gas from Baumgarten and distributing it to Germany, to Italy, to Hungary, etc. Then moved on already to natural gas storage. That was my first contact with storage in general. And later on in my journey, I was also involved in some pump storage projects or optimizing them in Austria for customers with software. That's by chance also how we started out at Enspired. Our first asset was a pump storage again. And in 2021, we signed our first battery storage with the idea that it's kind of a simple version of a pump storage, right? There is no cascades, no pumping, turbining switches. And in theory, battery is an easy pump storage until you get into the details of warranties. And so it has its other tricks and traits compared to a pump storage. But actually, I was always in touch with the topic of storage for the last, 18 years or so in different forms and with different commodities.
Fantastic. And that's probably a great segue for you to tell us a little bit about how Enspire works with battery developers and then asset owners in to kind of optimize the revenues of a battery. So you talked about how pump storage was the, I guess, precursor to some of that. And so tell us a little bit about kind of how batteries are different and how you work with developers to kind of help them make the most of their assets.
Yeah, you have to think that I'm rather coming from the utility world, right? And so when we did business in the previous companies or for other asset classes, typically the asset is already there, right? It's more or less waiting for you to show up with your fancy software or service and is ready to be used. And that's how we also approached battery storage, right? We thought like, okay, let's let the investors build the stuff and then show up and ask us for our service. What we realized over the last years is that actually we can drive a lot of value already earlier in the process, right? So we were approached with questions regarding sizing, right? What So they build a 1 hour storage like in the old world, so 1 megawatt, 1 megawatt hours, or 10 megawatt hours, or should build a 2 hour storage or longer, or what's going on in other countries like California, and why do they build 8 hour storages, right? And shouldn't we do that also in Europe? So gradually we moved away from that idea of please talk to us only when you have an asset live, to supporting everything in relation to revenue generation or revenue optimization, right? And so we're typically involved early in terms of sizing, be it grid scale, be it co-located, be it behind the meter, because sizing has a huge impact on the revenue potential and how you in a day-to-day allocate the power and capacity to different markets. We're involved in performance warranties a lot. So another factor that's heavily underestimated with the impact on revenue. So we start already before ready to build, I would say, even sometimes helping. We're not consultants, right? It's not a paid service by us. We see that as part of our service to then achieve an optimal outcome when the asset is really live. So we join even supplier discussion, warranty discussions, sizing discussions. We delivered simulated dispatch profiles to grid operators to convince them that the battery is not harming the grid, etc. So we try to really ease that process with our technology wherever we can, and that's just part of our onboarding that starts earlier than initially planned.
Fantastic. And I want to come back to this point about what are some of the key value drivers for batteries, the way you see it. But before we do that, I wanted to get everyone on the same page and talk a little bit about kind of what we actually mean by trading a battery. So how is kind of optimizing a battery from your perspective any different from just kind of buying when prices are low and selling when prices are high? How does this get complicated? Why do you need an optimization algorithm to do this?
Yeah, I prefer honestly optimization because we're talking a physical asset and mainly physical contracts, right? When you trade something for a battery, you have to deliver it some hours later or the next day or to the grid operator. Trading always creates that picture of there is some fancy magic sauce in the background, and sometimes it has a negative touch, right? So when we say optimizing the battery, it's basically boils down to the decision-making process of where to allocate an asset. It's a daily decision that has to be taken day ahead before 8 in the morning. So before the first auction, which is frequency containment reserve on the continent, how to smartly allocate it to maximize the revenues or returns of that asset, right? And this is the key differentiator, right? It's just not sufficient if you have a low latency algorithm and you're good in wholesales, or if you have a good price prediction for ancillary services. The magic lies in optimization of the services, right? Because you move cycles from one revenue stream to another. You have to consider your bidding strategy that impacts throughput or performance warranties like average SOC levels, etc. So you cannot optimize them isolated. I mean, you can, but you will have like 30-40% less revenues than we have. And that makes it so special that the variance you have there ahead is like if you would count them, there are billions, right? You can slice the power that impacts the capacity. You have 4 hour blocks, you have 15-minute auctions, you could trade in hours. So there is endless possibilities. And the job of an optimizer is to say the day before or in the morning, tomorrow, based on the fundamental situation, is it weekend? Is it a Monday? What's the load? What's the residential load or the residual load? How to allocate the assets and generate maximum revenues, right? That's what it's all about. And trading would rather refer just to one revenue stream, right? That's why I'm in favor of optimization.
Understood. And you kind of mentioned a little bit kind of frequency containment, for example, and the reality is that as you're saying, optimizing a battery does imply participating across a large number of kind of markets. So, what's called kind of revenue stacking. Now, ancillary services, to make matters more complicated, do vary kind of by country, but there are some commonalities. So maybe for our audience that is less familiar with this, with a broad definition of these services in mind, can you break down the main revenue buckets as you see it for batteries and why, you might switch between hour to hour between the different revenue streams?
Yeah, so I would say mainly you have on the one hand side ancillary services where your counterpart is the grid operator. So the main reason is procuring services to ensure grid stability, right? The difference between the ancillary services, and they have it in common across country, is just the speed of ramping or availability of the service to accommodate different asset classes, right? There is things batteries can do that coal plants cannot do. And there is slower services that more or less all plants, including diesel generators, could deliver, right? Normally, the more assets can deliver this service, the lower the value, right? And the more specific, the higher the value of the service. But it's very important to understand that your customer is the grid operator. And the second component is that we're talking real-time markets, right? You trade them for the future, but a lot of it is happening during delivery right now, right?
Yes.
The second big market is wholesales that you typically trade on power exchanges. So you don't know your counterpart, right? I could be buying from you, but I will never know. I don't know, do I buy green electricity or do I buy from a coal plant, right? That's why the European energy mix is applied to that electricity, because you just don't know. That's part of the anonymous behavior of an exchange. And that's typically a market only for the future, right? You trade average power for quarter hours, half hours, 4 hours, depending on the market. And then you have gate closure either at delivery or sometime before.
Mm-hmm.
And then you just deliver the average power, right? The business is done. You just deliver. And that's another thing in optimization that you have to consider. There is some parts of the revenue stack that you can influence into the future. And there is others where you can bid and you will only find out like A4R on a 4-second by 4-second call, right? So you can bid, but you don't know yet if you're executed. And that real-time execution, of course, impacts the future, because maybe the grid is long or short and you get fully charged and suddenly you come out with a higher state of charge than you initially expected. In wholesales, I can lock in my state of charge for the future, right?
Yes.
So you have to bring together those two timings, and then of course some special variants, like in some countries you're allowed to trade against imbalances.
Yes.
Some countries have one imbalance price, some countries have asymmetric imbalance prices, depending if you're on the right or wrong side. That increases complexity. But we also have assets like in these markets, like the Netherlands, for example, that would also be managed by the grid operator. It's just a separate, I would call it, revenue stream, because it's not bid into upfront like in an auction or whatever. It's not used by the tiers also. It's just an optionality that you have as optimizer.
Absolutely. And I guess, to make this even more complicated, and I do appreciate you keeping it very simple, some markets also have a kind of reserve price or a kind of capacity price and then an energy price, right? So there's also kind of the optimization of whether you want to lock in something with a probability of being dispatched, but it's also not guaranteed. So yeah, this is all very difficult and probably gives our listeners a pretty good sense of as to why you need some algorithms to do this efficiently. I promised we would demystify some kind of key kind of concepts. And so one of the other things before we get into some more details about how you're doing the optimization, listeners, kind of clients often ask about tolling agreements, floors, day ahead swaps, etc. Can you give us the kind of two-sentence definition? Maybe that's too constraining, but a short definition of how each of those kind of arrangements how they work, and probably more importantly, how they help underwrite the cash flows for a battery for the purposes of financing.
Yes, of course. So it's very important to understand that the world was fully merchant in the past, right? So a lot of players in the markets, use tolling like would be the most normal thing ever, right? But there is just a handful of deals signed in Europe. And we experienced it firsthand. So we had a fully merchant asset signed, I think, end of 23. And then the bank asked and said, hey, we heard about there is floors out there, right? So floor is per definition the minimum guaranteed revenue The rest is compensated via revenue sharing, like in a merchant setup. So you just know that you don't fall, I don't know, whatever number, 60,000 euros per megawatt per year, 80,000, right? It's a matter of price, and you can adjust the floor, and it will impact the revenue share you have to pay. Simple as that. And we went out, organized some floor offers for the asset owner. The bank looked at it, the asset owner looked at it and said, I totally believe in the battery market. We will never hit that floor, right? It's too low. But it's a floor, right? And then they came back and said, I heard there is tolling out there. And if somebody says tolling, let's differentiate it. They typically talk about physical tolling. So somebody is leasing the asset over a certain amount of time, 3, 5, 10 years. I would say on average, a lot of people looking at 5 years. Can also discuss why and what's the difference. So they want to rent the battery instead of building it on their own. Technical risk stays with the asset owner, and the market risk of outperforming the tolling is with the off-taker. So tolling is basically, I give you 120,000 euros per megawatt per year over a certain period, and I do with the asset whatever I want, of course, according to performance warranties, etc. And you go to your bank and you say, I get this amount fixed. Ideally, your debt payment is lower, right? And you know your IRR, etc. There is a variant, a financial tolling, where the asset owner chooses more or less the merchant optimizer. And the financial toll is a fixed for floating, like you maybe know it from other industries and markets and commodities. So it's rather an onboarding of the market risk without the physical capabilities of dispatching the asset, right? You have to rely that the merchant revenues of the optimizer outperform what you have promised as tolling, right? And the two are sometimes mixed up. So there is physical with access to the battery. So you decide. There is financial where you just take the market risk. It's also very common, for example, in Australia, etc. Yes, and then you go to the bank, and then the bank said, to finish my story, but I've seen the merchant predictions, and actually, yeah, the tolling is okay-ish, but the IRR I could get with the merchant forecast, right, that you get from bankable forecast providers. Sounds way more exciting. And this process took like, I think, 10 months, and the customer ended up in a fully merchant setup at the end, right? So that's something we experience very often. Meanwhile, people getting more creative. So I mentioned the floor and the tolling variants. We've seen cap and floor, which is a mix, which is actually a very attractive product. You just don't believe in or take the full upside, but just up to the cap, like you may know it from interest rates, etc. We see the ahead swaps out there from 1 to 10 years. It's a purely financial product where the offtake guarantees you a day-ahead spread. So the swap has to be bound to an underlying. So typically the day-ahead spread that you see published on social media all the time because it's the easiest indicator. And we typically tell our customers to look very carefully because it's very hard for a swap to anticipate how much you pay for it, right? If the swap is now at 70,000 euros per megawatt over 2 years, I don't know, you would have to look at asset owner what you think the day ahead spreads are, because whenever you're above that, you pay it to the swap provider, right? Mm-hmm. So compared to a floor or a cap and floor where you have the percentage written in the contract, the day ahead swap doesn't tell you that, right? Yes. You can just assume that the people that write the swap are smart, right? And have a good view on the future and did not design the product to lose money. Right, so that's you have to keep in mind. You can look at the hindsight. That's what we do with our customers. We can tell them how that swap would have performed last year, for example, so that they get a feeling for it. So while the product makes sense if you come from that world, it's really hard for some asset owners to assess the costs. And then there are some special variants like physically day-ahead options, right? Similar topic. You don't know how the option is exercised for the future. So it's hard for an optimizer to assess the impact. We have seen floating indices. We've seen framework deals for portfolios that defined prices based on COD dates and specifications. So I would say the market has not settled in yet on on one product. It really depends on the risk appetite or the expected risk return profile of the investor, right? That's different if your investor is a pension fund compared to you have a private investor that fully believes in merchant revenues that will shape the decision, and the bank you have. And of course, all things can be mixed, right? You can just toll 50% physically or financial and take the other part merchant. So that's where the market is, but the discussion is exactly 1 year old, so it's really early and far away from mature and standardized products, right?
Yeah, and that's a good reminder, right? Because as you say, tolling agreements have been around for a very long time as a general concept, right? So we think about
Yes.
kind of OTGTs, CCGTs, but they haven't really been around that long for batteries. And so I do think it's important to explore the different options that are available before you settle in with something. To that note, and I think I know the answer to this already based on what you just said, but from your perspective, is there any particular arrangement that you're seeing kind of more common across the projects that you're kind of optimizing? Or from your perspective, that strike a good balance between the flexibility that presumably you need to kind of optimize the battery and that kind of certainty that lenders would need in order to lend to the project?
I can just give you an educated guess based on
Yes.
based on our discussions. I think it will be something in the range of partial tolling, right? Because all the asset owners are total believers of that batteries add value. And there is this, I would say, emotional conflict of you build a battery, you put in 2 years, 3 years of hard work to get that thing live. And so you're emotionally totally invested into that market and how much value it adds. So I think a lot of people have problems with the full tolling just emotionally because they just believe that you can make double the amount of money, right? The bankable forecasts tell it. We published our optimization performance that tells it. So I think it will be a mix, no matter if it's then high floors or partial tolls, etc. In the end, you can put them all next to each other and they will just show you a risk return profile. Simple as that, right? And you can just tweak how steep the curve is, or if you take all the upside or a part of that. And I think the market is just in that situation. So very often we get, give us all the options that you have, right? Because we want to make up our mind. It's rarely that somebody says, I want to have an 80K floor. Actually, that never happens, right? They say, give me a toll for 3 years, for 5 years, for 7 years, for different variants. And how about a floor? And how the cap and floor? And can I mix that with a swap? And is that a problem? And so that's currently the discussions that we see. So I think the truth is somewhere in the middle of all these options.
Absolutely. And as an asset owner, presumably you also, there's how you optimize the battery, but I guess there's also kind of how the market develops as a whole, right? And so understanding a bit of kind of the evolution of day ahead markets, intraday markets, ancillary services as a whole that's internally consistent. It's also incredibly important to think about kind of what that range of possibilities are, right? So it's not just the range of possibilities that come from different optimization strategies, as you rightly said before, but the range of possibilities that come from very different worlds evolving over the next kind of several years. Jürgen, we've been talking about kind of battery optimization in a broader sense. In some ways, I guess you could assume that it's kind of standalone batteries that we have been discussing, even though we haven't explicitly said so. But there are important differences between optimizing a standalone battery and optimizing a co-located one. What I mean by that is a kind of battery that's kind of sitting next to a kind of solar asset or a wind asset or a combination of both. Can you tell us a little bit how co-location changes the optimization dynamic and the ability to optimize batteries across the different markets?
Yes. So indeed, it would be very easy to apply everything we talked before to a grid scale asset. What you get as an additional parameter is the shared grid access, more or less, right? From a pure financial perspective, in theory, it doesn't make a huge difference, right? So we have co-located setups with PV since 2022, end of 2021, I think, end of 2021 even, mainly PV, less wind in general in the markets. And this grid access makes a huge difference, right? And as always, when a topic is rather new, there is various different opinions in the market from nearly no impact to a lot of impact. Actually, I have to deliver the consulting answer that is, it depends. Because if you overbuild your PV, right, and try to offset that with a battery, that means if PV fully delivers or feeds into the grid, the battery is forced to charge, for example, right? Naturally, these activities are anyways correlated via the market price. I mean, we see it now already with a lot of negative prices during noon, but you have to be aware that why the PV is fully charging. In the easiest way to explain it, you can additionally discharge. So, for example, you cannot bid into frequency containment reserve, right? Which is a bilateral or bidirectional product for charging and discharging. And you are just limited by the meter. So there is certain, especially ancillary services revenues that you cannot physically, right? Because your grid access is used to its full extent by the PV. The same is for AFRR up, so where you would discharge the battery for whatever reason. Now, a lot of people or listeners would maybe say that's totally unlogical, but fact is that this is why we, for example, in Germany have the discussion about the price zone reviews, because the price signals are triggered from a market perspective and not from a local grid perspective. So even if it's rare occasions, it could be, of course, that PV is feeding in and an ancillary services call would ask you to discharge your battery. And if you have ever been involved in ancillary services, this is nothing what you want to have, that you have been contracted by the grid operator and you cannot physically deliver, right? There is a ton of penalties and even the risk to lose your balancing agreement with the TSO if you contract capacity and then you do not deliver. So I would say it really depends on the technical setup. The impact could be smaller-ish, a single-digit percentage, or it could be higher, up to 20%, right? And we help, as I said before, our customers very early in the process. We can use our technology that we use also in production and simulate the impact of different durations, different cycles, and different sizes in relation to the grid access. So we can tell a customer upfront how the battery would have behaved on very high resolution, for example, for the last 12 or 18 months.
And maybe, Jürgen, could you give our listeners a bit of a sense of, so you've talked a little bit about the importance of the sizing of kind of power to energy ratios. Earlier you mentioned performance warranties. Can you tell us a little bit from your experience, what are some of the most important decisions around those parameters that drive the ability to optimize a battery? And let's collocate it in this case for argument's sake.
I think that's independent of co-located, standalone, or behind the meter. So the duration is, I would say, the biggest decision in terms of impact on capex, right? I mean, I know the cells are getting cheaper and cheaper, dramatically since we've started some years ago, but that's the impact on capex. And the second topic is it's a commitment to how you believe the market works in the future, right? Shorter durations, so 10 megawatt hours, 1 hour storages favor prices for power, right? Like frequency services. Longer durations, 2 hours or more, favor moving energy over time, right? That's what we see also in California, Australia, etc. And the thing is now, 3-4 years ago, people just built 1 hour storages. So we have some rather new ones in our portfolio. And they are now limited to participating in certain markets or with certain optimization strategies, right? Because there is just not enough energy there to be really creative in trading. And now we face the same decision. So all the new assets that go live that we have signed are typically 2 hour storages. And the questions is 3, 4, 5 years down the road. And yes, the business cases are like 10 years or more. Maybe it would have been better to build a 3 or 4 hour storage. We also have 4 hour storages in our in our portfolio. So we will see. At the moment, it doesn't make a huge difference, to be honest. But with PV rollout continuing like in the last years, let's see how that changes. But that's, to be honest, not our job, right? That's the job of forecasters like you are.
That's our
You
job.
have your Yeah, exactly. You have your fundamental model, and you could for sure recommend what's the best duration in Germany in 2030, whatever. But this is one decision. The other decision is the supplier. So we're not involved in terms of technical performance, right? If the product is good or bad, or how about fire safety, etc. We just see some usual suspects out in the market that are always among the top 2 or 3. When customers choose grid scale assets, what we are more looking into is the performance warranties, right? Cycles, resting periods, average SOC levels, rolling SOC windows. So the things get quite complex very fast and need to be optimized in real time. So we have these huge day ahead decisions that we take the day before delivery, and then we have like 8 to 10,000 optimization runs to re-optimize the position, because weather changes, power plants go out of the market unplanned. You get different frequency costs than you expected. You have to do SOC management as part of the ancillary services. So whoever thinks, cool, I look at the day ahead auction and I buy at the lowest price and then sell at the highest price, misses out all the real-time interaction a battery has with the market. And the performance warranties tell you how flexible you are in that behavior or not. So I think that's the two most important ones, similar important, no matter if it's standalone or co-located.
That's fascinating, right? Because what you've just said is you've outlined how, on the one hand, you have, the need to kind of optimize for things that you won't know they ahead as, so things are
Yeah.
constantly changing, kind of minute by minute. But on the other hand, also the importance of thinking about the long-term evolution of the market as the two key kind of drivers. And I think that second one, or your first one, is a really good point, right? Because I think there are a lot of projections and battery optimization algorithms that rely heavily on what has happened historically. And the reality is that you need to consider how these markets are going to evolve over time if you want to capture those dynamics of what happens to the profile of prices, depending on how much solar you get in the system, how much flexible demand you get in the system, all of those things that a kind of historical analysis just won't get you when you're thinking about how the participation of batteries evolves in the market.
Yes, and the good thing is you already see it now, Anna, because when you look at our performance of the 1 hour storage portfolio that we publish, you also see the minimum and maximum. And there is certain months where a half of a cycle makes a 20 to 30% difference in revenue, right? So you have to imagine, just to quantify that, you have a basically a very similar dimensioned asset. So we only compare assets with similar layouts. And we look at asset A and makes like 20, 30% less than the other asset that has half a cycle more. And that, of course, depends if it's a month where the moving of energy, which is typically more cycling intensive, is favored, or if it's super boring winter where a lot of the revenues come from the capacities.
Yes.
And I think it's very important for asset owners to get as many data points as possible to make up their minds what they think the energy market in 5 or 8 years will look like and with what assets they want to be in that game.
Fantastic. Now, I'm conscious of time, Jürgen, and I wanted to do what I call kind of quick answer round. So I'll give you kind of a couple of kind of questions, and then it'd be great to hear your very short kind of version of an answer on those. So the first one is, and very much with, kind of the Iberia blackout. The question is, do you think grid forming inverters will become mandatory for renewable assets like solar and wind, or for the batteries that are associated with them?
I'm not sure if they would be mandatory because that would be a regulatory change and that would take quite some time, right? I think more and more people will just naturally look into it, especially for PV, it would be important. So short answer, yes.
Fantastic. Second question, what do you think is the most overlooked driver of battery value when developers are first evaluating their projects?
I would say performance warranties because you typically look into sizing, which is very natural because it impacts CapEx. Then you look at your supplier, and we actually had customers who signed up the supplier without knowing the performance warranties at all.
Wow.
And just got them after they have signed up with the supplier. I hope meanwhile that's a thing of the past. But I think a lot of people didn't know that the impact could be plus minus 10 or even 20% on their actual revenues.
That's fascinating. And then final question, what do you think is the biggest misconception that investors have about merchant batteries? And by investors, I mean kind of the developers, the owners, but also the lenders, I guess, if you want to broaden the question a bit.
We don't see really misconceptions. We just experience that a lot of people haven't considered seasonality at all. And they're always fascinated when we show them our portfolio performance, and they see that the COD before summer heavily impacts the business case compared to moving the COD by 5 months, which in general is what we see in the market, that we had one customer who was before planned COD, 100 megawatt, 103.5 megawatt asset that just went live in Germany. And I think most other assets are delayed. So I wouldn't say it's a misconception, but I think a lot of developers think it's easier than it really is, and which leads into the delays and then sometimes into lower revenues as compared to what they initially planned.
It's very interesting. Fantastic. So, Jürgen, thank you so much for joining us today. It has been a pleasure having you on the podcast and learning from your extensive experience.
Thanks, Anna.
And thank you very much to our listeners for tuning into this episode of Energy Unplugged.
That was Ana Barillas, Aurora's Managing Director for Iberia and Latin America, talking to Jürgen Mayerhofer, CEO and co-founder of Enspired. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.